Hello, good morning. Welcome to the session. Today we'll continue the basic terms in accounting. Yesterday we have done some area. Now I think around 5 sessions we can complete this topic, basic terms, terminology in accounting. After that we'll go to the practical accounting. And also I think if we get time we can study it, we can discuss about the accounting, computerized accounting softwares, just like one of the softwares, Tally, and I think Tally and Sage 50 is also one of the important. We can discuss about that. Anyhow, we'll go to the slide. Okay, yesterday we discussed about the expenses, assets, different types of asset and expenses, direct expense and indirect expenses. I think we stopped indirect expense, overheads. Now the next term today we'll discuss about the liabilities. Liabilities actually it is in Arabic, it is called mas'uliyat, liabilities, dues and obligations of the business to outsiders. Actually, there are two types of liabilities: dues and obligations of the business to internal or insiders. That means internal liability. It means the liability of the business to businessman. It is normally called it is capital or equity. Capital. Actually, capital is a liability, but it is internal liability. Now we normally use this liability in context of external liabilities. That liability, dues and obligations of the business to outsiders. So otherwise, the other internal liability is termed as which one? Capital and equity. So we need not discuss about capital and equity again. But we have to understand it is also a liability, a credit aspect. It will come in liability side of balance sheet always. Then the liabilities, there are two types of liabilities: dues and obligations of the to the others, outsiders. It is current liability and non-current liability. Current liability is just like current asset. Just yesterday we discussed about current asset, the asset which can be converted to cash within 1 year. Just like the same meaning, we can just reverse the liabilities which are to be paid within 1 year, or short-term liabilities. That means dues and obligations to be paid within 1 year. Within a short period we have to pay. It is called current liabilities. So short-term or current liability. Then non-current liabilities, or it is called long-term liabilities. It is just like the liabilities which extend more than 1 year, which is liabilities which can be paid after 1 year. It may take 1 year, 5 to 10, 10 to 20 or 30 years, any number of years. So long-term liabilities, actually there are two controversial, this is a controversial area. There are some experts tell it is, there are three types of liabilities. Liabilities, current liability, or short-term, medium-term, long-term. So they made it like up to 1 year it is short-term, current liability, 1 to 5 year, medium-term, and more than 5 year, long-term. But in our terminology or our context, that means in our outcome there is only two. It's normally accepted, what you call commonly accepted liabilities are only two: current liability and non-current liability. So we'll discuss about that. We'll go to the next slide in detail about liabilities. So now the current liabilities, I told it is, we discussed already. Current liabilities are the liabilities which are to be paid, or dues and obligations of the business which is to be met or which is to be honored within 1 year. So examples are given: cash and dividend payable. One is cash, cash and dividend payable. So it is actually not only dividend, all the expense payable. Any rent payable, salary payable, any expense it is payable. That means due but not paid. Normally it is called outstanding expenses, or any expense payable. Here it is dividend payable, or it is called proposed dividend. It is normally in company balance sheet. It is a common current liability. That is why cash dividend payable. It is no most of the business, those who are having what you call in shares and dividend is to be, first you have to understand dividend. What is dividend? So dividend is actually, it is a portion of profit that is called qismul arbah. Arbah means profit, a portion of profit which is to be distributed, which is distributed to the shareholders, mainly equity shareholders. It is called dividend, because equity shareholders and preference share both are dividend, but debenture holders and bond or different other liability holders, we are paying interest. So dividend is the portion of profit which is to be paid to shareholders. You can tell it is shareholders. So dividend, the term Arabic in it is qismul arba. So it is also a current liability because it is to be paid within 1 year. For example, today, this year, it is to be declared. At least next year, in Jan or February, it is to be paid. So just like declaration, this year, end of the day, for example, in balance sheet and finalization, at the time of finalization of balance sheet, will declare, the company will decide to distribute. So it is called proposed dividend. Next year, maybe before within 3 months, maybe approximately 3 months, it is to be paid. So up to that, it is 3 months or 4 months only due, not more than 1 year. That is why it is a current liability. Then accrued expense. Accrued expense means actually it is expense due but not paid. You have to pay that, so you incurred the expense. It is met already but not paid. For example, any electricity bill or insurance, sometimes it will be outstanding, or rent outstanding. Rent is to be paid. Last month, rent is not paid. So this month, when it is to be, this month we will tell, or last year's rent is not paid. This year we will tell it is outstanding rent or accrued expense. So outstanding rent or accrued expense, both are same. Both, it is a current liability. Then short-term notes and payable. Then there are so many promissory notes, IOU, bills payable, like payable notes. That means we have given some promise. We will pay the money in within short time, 3 months, 5 months, or 6 months, or a maximum 1 year. This type of notes, if there is a short notes, short period liability, or it is called, normally it is called notes payable, a promissory note, bills payable, like that. It is, the company issues that sometimes when there is a temporary need of money, funds. Then account payable. Another is account payable. Account payable, just like we discussed in current asset, we discussed already. Account receivable. That means bills receivable plus sundry credit, sundry debtors. Here it is just opposite. Bills payable plus sundry creditors. Sundry creditors means it is called zabain. Creditor means da'in. So, or zabain, customer. So the total amount to be paid to creditors, total da'in or da'inat, plus bills payable. It is called account payable. This also recently in all the final accounts, or according to new standards, it is account payable. There is no sundry creditors or bills payable. It's only accounts payable. It's short. It is both collectively known. Then another is tax payable. Tax payable are just like dividend payable. Tax, proposed tax due but not paid. Assessed already, but we have to pay. It is tax payable is also a good example for current liabilities. And unearned revenue. Revenue earned, but it is not due. Actually, unearned revenue is not like the what you call accrued revenue. Revenue, that means revenues two types are there. Before in as current asset we discussed about accrued revenue due but not received. It is accrued revenue, outstanding revenue. It is a current asset. But here unearned revenue already received, but it is not due. It is unearned. We didn't earn that. It means it is our liability, mas'uliyah. So it is actually this revenue, unearned revenue. Also, it can be prepayment or advance, muqaddam. It is we received the revenue in advance, muqaddam. So revenue received in advance. Dakhal, or the revenue in advance. So it is called unearned revenue is also an example. These are the best examples for current liabilities. Then also there are some other current liabilities. Whenever the practical session continue, at that time we'll discuss about it. If you have the 5 or many or 6 current liabilities, most commonly used current liabilities, you will get other current liabilities you can understand easily. So once again, dividend payable, accrued expense, short-term notes payable, or anything like bills payable, IOU. It is also a document. It is a negotiable, not negotiable. It is a just like promissory note. IOU, Anamuddin Lakh. That means I have to pay money within a short time. I give with stamp and seal, and after the maybe 6 months they will bring that, I will give them. So account payable, tax payable, and unearned revenue. These are the example for current liabilities. Then we'll go to the next slide. That is long-term liabilities or non-current liabilities. There are all the non-current liabilities. Now what will be the liabilities which extend more than 1 year, which are to be paid more than 1 year. The duration is more than long-term. The liabilities which are to be paid after 1 year, or which may be extended under more than 1 year, which can be extended more than 1 year. It can be called long-term liabilities. Now, long-term liabilities examples are bonds and debentures, then term loans and fixed deposit, unsecured loan, foreign currency loan. These are all examples for long-term liabilities. So one among these bonds or debenture. Normally debenture and bonds. These are the one of the most important debenture, bond, and loans. These three are secured and unsecured. Both loans are. These three are the most important long-term liabilities to be studied. Fixed deposit actually it is in different way. We'll discuss. So bond, what is Sanadat al-Mali, Sanadat al-Mali. So this is debenture also same. That's all what you call long-term liabilities. That means when company in place of issuing shares, the company may issue debentures. But debentures and these two are actually there are difference. Debentures and bonds sometimes it is in different terminology it is used. But the term is same, but different context it is. The debenture can be normally debenture is issued by companies, private or public companies. Bond can be issued by individuals also. Then also there are many difference in bond and debenture. If you bond is normally it is debenture and bond. When compare, it is bond low risk factor is as most of the bonds are secured, mortgaged, or there will be what you call pledge of asset, pledge on the assets. That is why it is most of the bonds are secured, and then the risk is low, and that is why interest will also be low when compared to debenture. Debentures are mostly unsecured. There is no pledge or collateral securities we are not giving as guarantee. That means it is kafala. That means guarantee is not there in case of debenture. Most of the debentures are unsecured debentures. So we are not giving any pledging of asset. So that's another difference. And also that is the liquidation matter also it is different. For example, in liquidation, that means no preference for the bonds are having preference. When the company is dissolved, first to be paid the bonds, then debenture, then preference share, then equity share. Equity shares are the most risky. They are paid last. If the company is having at the after loss, company is liquidated, so most of the equity shareholders may not get their full original their investment, they may lose. So another is term loan. Term loan actually it is a loan already. Loan means qard ajal. That means term loan. Term loan is normally it is called long term. It may be from normally from 1 to 30 years, maybe 30 to more than. And so it's all normally short term means up to one year. After that, all term loan. It's called long term. Normally loan is called bank loan is called qard. This is qarb li ajal. That means they're having term. Unsecured loan is different. The loan which are not secured. There is no any pledge or no any what do you call collateral securities. We are not giving any guarantee, or it is called rahan. That means guarantee or security. Then we have fixed deposit. Actually, fixed deposit, if you have this fixed deposit, is actually you have to you should not be confused. If you have fixed deposit in a bank, it is a fixed asset. Asset, that means that amount it can be realized. That is why it is a fixed asset. But this fixed deposit is in case of banks accepting fixed deposit, then it is a bank. For bank, it is a long-term liability or non-current liability. Just like a business, if business is accepting any, the company is accepting any deposit from customers or from employees or anyone, it is a liability. This is that type of liabilities. Fixed deposit, not deposited money, investment, istismar. If you have invested money in a bank, istismar or investment, that is different. That is your fixed asset. Then another is for foreign currency loans. Loans, you are taking loans in foreign currencies. For example, it is mostly in import and export business. We need foreign currency loans. For example, in euro or in dollar or in pound, like different foreign currencies, we are taking, we are getting loans. That's also long-term loans which are to be paid in after which extend more than 1 year. So these are all types of different types of long-term loans, long-term liabilities or liability which extend more than 1 year. There is, for us, for our what do you call convenience, we are not making three. That means long-term, medium-term, short-term. We have only long-term or short-term. So this is about the liabilities. Then with these liabilities and all, we will study later in detail. For example, this so many what do you call features are there. For example, debenture. Debenture, there are different types of debentures. Debentures are there, convertible debentures are there, redeemable debentures are there, and so many cumulative, like that, so many type of bonds, only one. So what is convertible debentures, which after a fixed period you can convert into equity share. So convertible debentures, a 5-year convertible, like that. So we have to understand this is a broad topic. We have a lot of things to discuss about this, but later we'll discuss. Now just terminology, you understand this all long-term liabilities. Now we'll go to the next is revenue and profit. This is also a very important term to understand. Most often the student may get confused. Revenue and profit both are same. Actually, revenue means the term used is dakhal or idarat. What do you call it? Irada. So that is actually revenue. Most oftenly used term is dakhal. But for profit, we are using arbah. That means net profit. For safi, arbah safi, or ijmal safi, gross profit, like that. Profit is different. Revenue means total income. That means whatever the sale income, revenue from sale or revenue from service revenue, it is all your revenue. It is called total gross amount. But profit means from this revenue you minus all the expenses, then you will get profit. So profit is the difference between revenue and expenses. That it's simple word, but we'll discuss later in detail. So revenue and al-irada, or it is called dakhal. Profit is normally called it is arbah. Then another term we have to discuss is income. What the different types of incomes. Revenue may be of different types. Direct income, indirect income. Actually, this is also most often it will may confuse. That means what are the direct income? Direct income is income earned from the sale of goods and service directly. Sale of goods you know already. Goods means the things in which the business is dealing only can be called goods. For example, if you are dealing with the furniture business, furniture is a goods. So from furniture, by selling furniture, if you are getting any income, it is called direct income. If you are giving service, transport service, from this transportation, if you are getting income, all the income from transportation, it is a direct income. But in case of a furniture businessman, he sell his car, old car he sell and get money. It is other income. It is not the direct income. It is indirect income, or it can be called other income. Any other, for example, the scrap or newspaper or old furniture, anything you can sell and get some money, that is not considered as direct income. So direct income is income earned or income received from the sale of goods or service. Sometimes by providing service, your maintenance service is provided, you are getting some income. You are an electrification company, so by doing the same service, you are getting some income. But some other sources you can get from interest from on deposit from bank. It is other income or indirect income. So direct income from direct sources, from the day-to-day operation of the business you are getting, it is called direct income. Then indirect income is entirely different. That means it is not from the routine or direct day-to-day operation of the business, or it is not from the business by dealing the goods in which you are dealing, the things in which you are dealing, but it is other. There are mainly 5 types of indirect income. Normally it is why any indirect, for sale of scrap, sale of old machine, old furniture, or sale of newspapers, or anything you can sale of scrap. So you can sell and get it. Also in Tally and all, there are 5 types of indirect income we have in accounting softwares. Computerized accounting, we are having 5 types of indirect income. One is interest received, discount received, commission received, dividend received, and interest, discount, commission, dividend, and rent. If you receive any of this, it is called indirect income. Normally, if you are in your building, there is an additional flat you gave for subletting. You gave subletted. That means you gave on rent. Total building you are getting your own building, or some portion of the building you use for your business. Some portion of building you are given for rent. So rent from that building, it is an indirect income. Or investment from bank, you are investing money, or in any other company in shares or investment, any other opportunities you are investing, you are getting interest. It is an indirect income. Or your commission, you are dealing some transaction and you are getting some commission in addition to your normal business. It is an indirect income. So dividend, that means I told you the portion of profit, because you have investment in some other company, equity shares or shares. From that you are getting income. It is a dividend income, or dividend received is also indirect income. Or commission or any discount. Sometimes you are buying goods in lump sum, in large quantities, you are getting discount. So in that you are getting discount, it is an indirect income. So this is all indirect income. So direct income directly from the sale of goods or providing service income, or sales, net sales. So it is direct income. All other 5 different types of indirect income: interest received, discount received, commission received, and dividend received, and also rent received. Normally, maybe some other occasion, extraordinary item may be there. Normally in accounting, there are 5 types of this type of income. So this you have to understand: income, direct and indirect income. Then we'll go to this gross profit. Gross profit you have to understand. I told the revenue minus cost of goods sold. Actually, this is a term used in very commonly used term: cost of goods sold. Gross profit. There are 2 profit. I told you before, 2 profit. One is arbah and ijmali. Second one is safi. Arbah, safi. That is net profit. Ijmali, safi. That means total profit. It is called gross profit. Gross profit is revenue minus cost of goods sold. Only direct expenses, direct material plus direct expense you are deducting from revenue. So you have to understand how to calculate cost of goods sold also. Cost of goods sold is calculated. Normally there is an equation: opening stock plus purchases. Purchases means net purchase. That means total purchase minus purchase returns. So opening stock plus net purchase plus purchase expense minus purchase expense means carriage inward. carriage on what do you call, carriage on purchase or carriage inward. If you have any expense you spend for bringing the goods to your factory in trading company. In manufacturing, there are so many other direct expenses you have to adjust, but normally in cost of goods sold in trading companies, opening stock plus net purchases plus purchase expense minus closing stock. So you'll get cost of goods sold. You are not deducting all other expenses, only this much. So this cost of goods sold from net revenue, that means revenue, revenue or net sales, total sales minus sales returns, you'll get net revenue. So revenue minus cost of goods sold, you will get gross profit. This actually in what you call, when you prepare the income statement, this is all separately or now written in what you call, according to International Accounting Standard. The comprehensive income statement is to be prepared. In that, cost of goods sold is to be calculated specific before in T form accounting. For example, in one side all expenses, one side all incomes, credit side incomes, debit side expense. Difference is net profit or gross profit. Normally, gross profit and net profit we are showing. Cost of goods sold is not shown. But in income statements, cost of goods sold is to be have a very important place. Most of the ratios, turnover ratios and profitability ratios, many ratios it is needed. Cost of goods sold is needed. So revenue minus cost of goods sold is net gross profit. Arbah al-ijmali. After that, from this gross profit, you deduct all expenses, you will get net profit. This is the concept or the equation of profit formula. But when you understand in practical side, you have to understand so many things. So all the expenses from gross profit, you have to deduct all expenses, non-productive expenses, all administrative, selling, distribution, and all other expenses, direct, indirect expenses. Direct expense you are included in cost of goods sold. So all indirect expenses you minus, or overheads you minus, or unproductive, non-productive, non-operating expenses also, everything you deduct, you will get net profit. So that all, just to understand the equation, gross profit is equal to revenue minus COGS, cost of goods sold. Net profit is equal to gross profit minus expenses. So next we have a small equation about the calculation of cost of goods sold. This here we can understand opening. Actually, it is a simplified. The equation is opening cost of goods sold is opening stock, opening inventory or opening stock plus purchases minus closing inventory. Actually, this purchase is total amount. It is included many things. Purchase returns are deducted and discount is deducted. Discount, that means when purchase you will get discount. So that discount received, that is deducted, and freight is added after the net purchase expense on purchase. So this is a purchase is like that, and after that closing inventory you have to minus. So for example, 4,500 plus 50,000. So in 50,000 you have to minus two things: 12,000, 5,000 plus 7,000. This 5,000 is a discount. It is to be deducted from purchase. This is total purchase minus discount. So how much? 45,000 minus 7. So 38,000 plus 10. So 48,000 plus 4,500. 48 plus 4, 52,500 minus 1,500 is equal to 51,000. So 51,000 is cost of goods sold. So you have to understand this is directly given. You have to calculate. You calculate and you get the correct amount, 51,000. You can understand that. So normal case we have equation like this: opening stock or opening inventory plus net purchases plus purchase expense. Net purchase means you have to understand purchase, total purchase minus purchase return and discount. If there is, you have to minus the net purchase. Then after that you have to add purchase expense and minus closing stock. So if you calculate, you will get the correctly. So when whiteboard is needed for calculation, it's just understand like this: 4,500 that means opening stock plus purchase. This purchase is net purchase. Net purchase, how to calculate? Total purchase 50,000 minus 5,045 minus 7,000, 38,000. 38,000 plus 10, 48. So 48,000 plus 4,500, 52,100 minus 1,500. So 51,000 you will get. So this is cost of goods sold, but this is very, very important in accounting. That is why the calculation I showed. But we will practice more in practical. When we are doing in practical accounting, we have to calculate how to calculate cost of goods sold. We have to study in detail. So we'll go to the next area, accounting equation. This is also very, very important topic, accounting equation. The basic double entry principle, accounting principle, dual aspect accounting or double entry principle. The principle of dual or dual aspect principle concept that is based on this. Asset is equal to liabilities plus equity. This from very, very simple example you can understand. Total asset, that means current asset and fixed asset. So here you get liabilities and equity. Equity, what is that? Capital. I told you equity and capital both are same. Capital means we studied before. That means capital. What you called for capital? That means Rasulmal capital and Qimatul Maliya. That is equity. Qima, it is total of total. But the difference is only capital is used in sole trading concern and partnership or proprietorship business and partnership. The term capital is used. But in company, corporate undertaking or corporate business companies, it is called equity, because equity shares are the owners' equity. They have, it is to be calculated separately. That is why. So anyhow, here the in place of capital, sometimes if the equation you can change. For example, asset is equal to liabilities plus capital in case of partnership and sole trading, but asset is equal to liabilities plus equity in case of corporate undertaking. But equity and capital both are same. For example, we can check one example. As sole trading concern, I have a capital. The amount invested by me is 50,000. I have 50,000. I invested my Rasulmal or capital is 50,000. I took loan from bank, 30,000. So 50 plus 30, 80,000 is my total amount, total capital. That means liabilities plus capital. So one is liability, I took 30,000. I brought 50,000, so 80,000. This 80,000 only I can invest in business. Fixed asset plus current asset, including cash, bank balance, and all other machine, furniture, fixtures, vehicle, everything. It should be 80,000. It should not exceed more than 80,000. That is the basic simple example. So how much my liabilities I took from others? That means I may be from banks, maybe from borrowing from outside, by issue of debentures, by issue of bonds, or any way I got, or from different financial institution I took loan. So these all my liabilities are 30,000. 50,000 my capital. So 80,000 is my total capitalization. This amount only I can invest in current asset and my fixed asset. That means I invest, I have bank deposit, I have cash, and I bought furniture, fixtures, vehicle, machine, and building. Everything should be, or all my fixed asset plus other current asset plus my cash balance. It should be 80,000. So it's a very simple equation. We can understand like that. So asset is, so here also there is another. Asset is equal to 80,000, liability 30, and equity 50, capital or equity 50. Now sometimes maybe liability may not be given. Asset is equal to 80,000, equity is equal to 50,000. So asset minus equity is equal, you will get liabilities, or equity sometime may not be given. So how to calculate asset minus liability? 50,000 minus liability 20,000. So it's equal to 30,000 equity. So it is different way you can, but it's very convenient and basic what you call term in accounting. Very commonly used term in accounting equation. Then another this for accounting equation. When we study about accounting equation, you have to understand assets. That is why here asset we discussed already. There is all the assets are included. Total assets is equal to total liabilities plus total capital, or total, in case of company, total equity. So assets, some examples are here because it is already in every company. The asset structure may be different. Now notes receivable, that is bill receivable. You sold goods on credit, that is why bill receivable. Land, building, equipment, stores, suppliers. Stores, supplies. Supplies means your goods purchased. It's also same as goods, or it can be considered as goods. Sometimes it will be supplies will be in the purchase in addition to goods. Anyhow, you can understand it's just like goods. Supplies, store supplies. Stores is different. Stores is stationery and all included in supplies. So stores and supplies. Vehicle, account receivable, and not receivable, account receivable. That is both are, I told you, account receivable is sundry debtors plus bill receivable. Notes payable means small promissory note, like that. You, if you have anything to, you have any notes to get money, not you have given, you have collected money through notes. This is a current liability. So cash. So all these assets. So assets is equal to liabilities. Liability, you know already, that is current liabilities and long term, what you call non-current or long-term liabilities. Total liabilities. So assets is equal to liabilities plus equity. Here equity you have to understand very well, because liability and asset we discussed earlier. So what is equity? Equity is actually, it is, I told you, it is a Qimatul Maliya, equity. In company only, corporate sector only, equity is most often used. Now we have to understand equity. When you consider equity, calculation of equity is very easy. Total asset minus liabilities, total liabilities, you will get equity. But if you want to calculate equity, how you calculate equity? Owner's investment, istisma, or investment, rasulmal, or capital. Your capital plus revenues. Revenue means your dakhal, or your arba, what do you call arba, profit or revenue. This is here, you can both are same, you can use here. Sometimes use synonymously, because revenue, if there is no any other expense, revenue will be net revenue, net income, or net profit, net earnings. These all terms can be used synonymously. But normal case, when you discuss revenue and profit, revenue is the total income, profit is total income minus total expenses profit. So the owner's investment or revenues you have to add, plus withdrawals. Withdrawals means actually owner's withdrawals for personal use. The goods or cash or goods withdrawn for personal use, that you have to minus, deduct. So withdrawal in Arabic it is called sahab al mal. So if you withdraw money for personal use, but if you take money and buy goods for the business, it is not withdrawal. Or you withdraw money from bank for and buy goods for business or bring to the business, it is not withdrawal. You withdraw, you take money for your personal use, to buy a personal property, or to buy a car for personal use. Anything you take money. So that is withdrawal. That is called withdrawal. The other one is not withdrawal. So withdrawal is goods or cash withdrawn for by the proprietor for his personal use. And expense also you have to deduct. So equity, how to calculate? So your total investment, that means capital or additional capital, or istismaria, that means investment, any type of investment, plus your revenue, minus your withdrawals, sahab, and minus your masrufat or nafqat, or all expenses, direct and indirect, all expenses you have to minus, then you will get equity. But when your equation, equity, how do you calculate? Total asset minus total liabilities is equal to equity. Then liability, how do you calculate? Asset minus equity is equal to liability. Asset is equal to liability plus equity. So this is accounting equation. You will study later in detail. Now we will have a brief explanation only. Then another, now we'll go to the last topic in this area. We'll discuss about the I don't want to prolong the session, maybe less than 1 hour, 45 minutes, like more than accounting. Now we can define accounting. Accounting, actually, if you discuss this accounting terminology first, you will get confused. Now you have some idea about what is asset, what is capital, what is equity, what is short-term or current asset or current liabilities, debenture, bonds, all this, some idea you have. Or you can repeat this what you call this session, and you can understand clearly what are the different terminologies. By using this, you can define accounting. But first, I did define accounting. You can by heart, but you will not understand. Now, accounting is defined as the art. It is an art and science, or art. Fania. It is an art of recording, classifying and summarizing. So accounting is an art of recording, classifying, summarizing. So you have to understand first what is this three. Recording means tasjil. Classifying means tasnif. Summarizing means talakhis. So first record, then post to ledger and make summary. So recording is actually recording the transaction in the books of account at first time. It is called journalizing. The term used in accounting terminology is journalizing. In the books of account and original books of account, first time the systematically and in chronological date order. Tarikh, date order, you are recording the transaction. It is called journal. So recording, or it is in Arabic, it is called tasjil. So all the transactions are recorded according to the systematic and chronological date order first. So it is how to record, it is different. You have to, for recording, you have to make debit and credit. There are rules, accounting rules you have to apply. That will study in other separate class. It is a very big topic, how to apply the rules of accounting or recording or rules of journalizing. So now you understand the definition of accounting. First, record the transaction, then tasnif. That means classify the transaction, post the transaction to different account. Now after recording, you have some assets are there, liabilities are there, many liabilities, many assets are there, land, building, premises, vehicle and all, you purchased everything. Liability, you take loan from bank, you have bank overdraft, you have the sundry creditors or the account payable, like this, so many liabilities are there. Then you have expenses are there, then you have incomes, and then your capital and equity. All this in each heads, there are different subheads. For example, in asset, there are current asset, fixed asset, different type. Many types of current and fixed asset. In liability, you have current and non-current liabilities. In expenses, you are many. In tally, there are, I told you, I mentioned more than 28 expenses. Direct, indirect expenses are there. And in revenues are there, we discussed already. Now many revenue, direct revenue, the income from sale or sales revenue and service revenue, and other 6 or 5 indirect revenues, all the indirect revenues, rent received, commission received and all, then plus capital and equity. All these different accounts you have to post to different heads of account. That is called classifying. So first record the transaction in the books of account. Original books of account is journal. The book of account, the book in which the transactions are recorded is called journal. The process is called journalizing. After you post to different account tasnif, then make a summary, talakhis. So make a summarizing. This summary is mainly three statements. One is trial balance, then profit and loss account and balance sheet. Or profit and loss account, most commonly used income statement. Balance sheet is statement of financial position. So now you have to understand trial balance for what? Trial balance, all these different ledger account. Maybe your company is having 35 accounts: cash account, rent account, furniture account, salary account, machinery account, vehicle, car account, or different capital account, bank, different 2 or 3 bank account maybe there. All these accounts, you are systematic, you are listing in a list, a statement, and if you are getting the total is same, debit balances and credit balance are same, it means the arithmetical accuracy is, if the arithmetical accuracy or correct, it's mathematically correct, it means all the transaction you have made the journal, you have made the posting to ledger account, balancing, totaling, casting, posting, casting, totaling, balancing, everything is correct if the trial balance is tallied. So tallying trial balance is half of the work of accountant in manual case. But in recently, if you use any accounting software, there is nothing to do. You have just to record the transaction, debit, credit, and the concerned respective group you have to identify. Then all this posting to ledger and not only posting to ledger and summarizing your trial balance, income statement, balance sheet, and ratios, analysis, and fund flow, cash flow, all the statement, everything is done by automatically, it will be done. Even in whether it is Tally, ERP9, Peachtree, QuickBook, or Sage 50 or SAP, any software, accounting software, if you are using, you need not do all this. but you have to understand it. The problem is what? Why we study this? We need an accountant need not do all this work. Why we have to study? Because if in recording only only recording debit, credit, and group and in accounting software, if you are doing, if there is any, if you don't know all the process, if there is any mistake, you cannot find. So you have to understand manually what is happening. That is why we are discussing. In manually, we are doing everything. And after that, the next you study the accounting by using computerized accounting software. Then it will be perfect. So summarizing, we are preparing trial balance. Trial balance is a list of all ledger accounts, balances. Mainly the main purpose of trial balance is to check the arithmetical accuracy of the ledger accounts. If the arithmetic mathematically accurate, trial balance tally, it means all your posting, journal, from journal posting to ledger account, and posting, totaling, casting, totaling, balancing, everything is correct. Up to balancing, it is correct. Then after that, you will, from the trial balance, you will prepare final account, income statement. Income statement, you can find a statement of income or profit and loss account, or trading and profit and loss account. In there will be gross profit and net profit, net income or net profit. You can calculate. That also will study, will understand the net profit equation. You understood now. Gross profit also, revenue minus cost of goods sold is equal to gross profit. Net profit is equal to gross profit minus all other expenses. That is the basic equation. But when you prepare this statement, you have to follow you have to understand very well. You have to follow a lot of rules and regulations are there, standards to be followed. And after that, balance sheet. Balance sheet is the normally called statement of financial position. It is a statement of financial position. You can financial standing or strength of the company. You can understand by the balance sheet. Balance sheet means one side liabilities, one side asset in T form. Otherwise, it is vertical balance sheet. Also, it is different way. In assets are liabilities and equity, shareholders equity or another equity is separately. You have to show that owners equity. So this is and a statement of owners. I'm telling this all the statement, three statement. It is we are preparing for diploma, but it is not in international accounting standard. According to an international accounting standard, there are 5 statements. That means trial balance is not there. There is income statement, balance sheet, statement of owner's equity, then cash flow statement. Fund flow is not there, only cash flow, plus the required notes. These are the, according to international accounting standard 1, the main 5 approved financial statement. But for us, for our understanding, it is only, here summarizing, we understand only 3: trial balance, income statement, and balance sheet. And transaction. So first you understood the accounting is an art of recording, tasjil, tasnif, classifying, and summarizing, talkhis, and all monetary terms, all the transaction we are recording, classifying, summarizing all transaction, only transaction which can be measured in terms of money. No any other qualitative or any other non-monetary transaction we are not including here. So preparation for the preparation of financial statement, that's okay. So recording, classifying, summarizing, and communicating. Actually, before communication, there is one more. 2 more is there. That is, one is analysis, tahleel. So this is another definition. According to this definition, it is communicating the result thereof to users of accounting. Finished. Accounting is over. But we have to include 2 more after recording, classifying, and summarizing. The normal, it is bookkeeping. It is called this part, recording, classifying, up to summarizing, up to preparation of final account. It is called bookkeeping. After that, we have to do a lot of things. That is means analysis, interpretation, and communication. There are 3 more. That is analysis, interpretation, and communication. So you have to understand. Actually, there are 5 functions of accounting or features. One is recording, tasjil, classifying, you are posting to different account, tasnif, and you are summarizing, talkhis, and after that your analysis, tahleel. You are just by preparing this balance sheet and income statement, you cannot take decision. You need to make so many type of analysis, like ratio analysis, fund flow, cash flow, common size analysis, vertical analysis, and horizontal analysis, and in other advanced analysis, in marginal costing you are using marginal costing, standard costing, like in different type of analysis. In financial accounting you are using this fund flow, cash flow, vertical, horizontal, like analysis, common size statement and all. So many types of analysis, tools of analysis is there. Actually in this course we are not discussing all this, just to understand analysis, tahleel, and after interpretation, tarjuma, you are translating this, all this your analysis to decision, that is decision making, interpretation, that's also a part of accounting. And after that, after interpreting the result means the net profit, gross profit, and financial balance sheet, the figures of balance sheet, from balance sheet, everything you are using for analysis, different ratio analysis itself, there are around more than 20 ratios. Liquidity ratios are there, many, current ratio, quick ratio, like that, and solvency ratios are there, profitability ratios are there, operating ratios are there, turnover ratios are there, working capital turnover, debtors turnover, creditors turnover, like that, and market ratios are there, EPS, earning per share, and market values are indicator of market value. So many ratios are there. So all these ratios are you are making analysis. If your ratio analysis, otherwise fund flow, cash flow, common size, all this vertical analysis, horizontal, all you can do. Ratio analysis itself you are doing. After that, the result interpreting, you are interpreting from this analysis, you make tarjuma, you translate to decision, interpretation, and after that, the result you communicate, tasilat, you communicate to users. That means stakeholders or users. So this is accounting. So accounting is, now you can understand little more clearly the accounting. But if the first class itself or the first session itself, I discuss all this financial statement, that this so many things, asset, liabilities, you will not understand anything. That is why definitions, it comes after having an idea. So now still we have a lot of terms to be discussed. So now you understand accounting is the art of recording, classifying, summarizing what transaction in terms of monetary transaction or transaction which can be measured in terms of money for the preparation of financial statement and communicating the result thereof to interested parties. Now you have to understand who are the interested parties in accounting. There are many people interested in accounting. We'll stop with this. This session will stop with interested parties. So who are the interested parties? Interested parties, it is not included in this, but you have to understand that there are external and internal users. First, you have to understand the internal users. Who are the internal users? The person who use the accounting information or the utilize this data, that means financial income statement and balance sheet. All these statements used by internal people, mainly the owner, the person who invests money, the owner. But owner means in case of corporate undertaking, shareholders or stockholders. So shareholders, owners, employees, mainly this, employees and management also, you can tell. These are the internal users. Once again, owners, management, shareholders, why it is also owners. Owners in corporate or in companies is called shareholders. Shareholders are the owners of a company. So owners and employees also inside the company. So these are internal dakhliya. That means the users, using the internal users of accounting information. So external users are there. For example, investors, potential investors, the person who want to invest in your business. He want to analyze your financial statement. He want to understand how far it is profitable, how the liquidity, solvency is how is, turnover position is how is, the operating efficiency. All this he has to analyze. So investors, potential investors. Then there are government want to understand your profitability, and also tax is paid on the basis of your net profit. So they have to get the information. Then tax authorities and government or regulatory agencies, for example, Muscat Security Market, every 3 months, quarterly, first quarter, second quarter, third quarter, and annual audited balance sheet. Everything audited and unaudited. So all this you have to send to the security market, it will be available in website. For example, in our company, last 10 years it is working, already listed. If it is a listed company, corporation, if you can go and within 1 second, you can, this 10 years of financial position and statement or financial statements, you can just by a click, you can download and you can analyze. If you want to invest, we have best 5 companies, you want to select the which one is the best one, you can use this all ratio or different type of analysis and decide in which company you have to invest money. So investors, potential investors, then suppliers, government, tax authorities, regulatory agencies, researchers, sometimes researchers for academics. For example, in the college itself, we use for ratio analysis, we use the statement of different companies. Any company, if you want to study about 2 company, compare the finance statement, we use like academician, researchers, all these people are external users. So external and internal users. Now you have to banks also, when you are taking a huge amount from bank as loan, bank has to understand whether the person can repay the money or not. So bank every month or every year, bank has to analyze the statement. And also suppliers, when you are buying goods, for example, from supplier, you are buying goods for 6-month credit. Now the position is okay, supplier, as the supplier understand. If the supplier want to understand, want to be satisfied, he has to understand what is your financial position. He has to analyze your finance. If it is a big amount, not for a small amount. If it is 1,000, 10, 15, 25,000 real, I bought goods from credit, and I with the according to terms, after 6 months I will pay. If the supplier, that means the supplier want to understand about my financial strength, he can analyze my financial statement. So he is also a user. So all these users collectively known as stakeholders, not stockholder. So shareholder, stockholder, stakeholder. These all terms you have to understand very clearly. Shareholder means share means ashram, or shareholder means masahim. So what is a shareholder? Means a person having a share or person invested in shares of the company is called shareholder, masahim. So maybe I have 10,000 real, one company, I want to, any company, I want to take shares of one company. One share is 10 real. I took 1,000 shares. So 1,000 into 10,000 I invested. So I am a shareholder having 10,000 investment. I invested my istisma or investment is 10,000. Now, what is stock? For 10,000 shares, it is collectively, if I am getting a stock certificate, it can be converted in stock. Then I will get one certificate. Stock, I am a stockholder. So stock is the collective what do you call, compiled or clubbed together shares. So it's slightly different only. Stockholder, shareholder, both are synonymously used. But share and stock is a little what do you call, collective amount. Share is separately, number of shares is mentioned. For example, I told you 1,000 shares of 10 each. But stock means one stock of 10,000 real, like that. It is a collective. The other one is according to the number. Then other is stakeholder is different. Stakeholder means all these interested parties, external and internal. We discuss many internal users like owners, shareholders, employees, management, and external we discuss like, for example, shareholder, investors, debenture holders, bond holders. These all not the owners. This all debenture, if debenture holders, bond holders, then potential investors and suppliers, government, tax authorities, then regulatory agencies, academicians, researchers, all these people collectively known as internal and external users, collectively known as stakeholders. So shareholder, stakeholder, stockholder. Shareholder, then stockholder, then stakeholder. Don't confuse, because it's most of the student. If many times I try to ask what is this difference, even though they are not very particular to distinguish, but you have to. For presently, I told you this question format is entirely different. That is 70 according to ACCA pattern of question, 70% of the question out of 100 marks, 70 marks are 70 marks are multiple choice question. So all this information in different way it may come. So you should be very well equipped. Before it was not the practical question you can have more important. Now the practical question, the rest of 30 marks, it is also case studies, not directly practical solving the problem. Case study type. So actually this is a higher order thinking level questions more important nowadays. So you have to understand, you have to distinguish everything very clearly. You have to understand and segregate the difference. I told you, for example, I told you the profit, arbah, revenue, dakhal, interest, faida, amula, commission, dividend, qism al-arbah. These all terms we cannot use as same. Revenue is different, profit is different, interest is different. All are earnings. We can all are earnings or income, but different occasions it is there. Profit, revenue, and interest, commission, dividend. Dividend, I told you, it is qism al-arbah, the portion of profit. You are getting dividend means you are getting a portion of profit. You are getting interest means you are getting interest, fixed installment interest you are getting. For example, you invested money in bank, 5% interest you are getting. So 50,000 you invested, 50,000 into 5 by 100, 2,500 every year you will get. It is fixed. There is no risk. But if you are investing in here in what do you call in Islamic banking, the same amount 50,000, they will not give 2,500 every year. If it is 5%, or if it is 10%, 5,000 they will not give every year. But in commercial bank they will give you if it is 10% for 50,000, 10 by 100, 5,000 every year you will get. There is no risk. But here they will give dividend. They will invest this money in different portfolios, different companies, different portfolio they will invest. Then from this, after pooling, after getting this different what you call profit, they will calculate your portion of profit for 50,000 how much. It may increase or decrease. Sometimes if this company's portfolio, different companies make huge profit, you will get more. If they make less, you will get less. So that is different. So in bank, you can commercial bank and this what you call Islamic banking system, you are getting the benefit earnings, but their calculation is different. Here you are getting, they are calculating directly percentage from your money. There you are calculating from all these earnings. They calculate proportionate earning they will give. That is why it is called qism al-arbah, or division of profit, dividend. Interest, it is faida. It is just interest calculated on your investment. So anyhow, we'll continue the class in next session. There are many terms we have to discuss. So if you are interested, you can subscribe so that you will get all this whenever I I upload the video. Almost every day there will be one session for the coming 1 month. I think it is free. There is no any books. That is why all the days it is the third one today, 21st, 22nd, and 23rd. Then every day, maybe in weekly 5 or 6 there will be. So you can get it. It will be helpful for, especially for diploma student. Even you have some knowledge, it is better. This video you can repeatedly, you can see 2-3 times, you will get clear idea about the concept. It will help you, I'm sure. Okay. Thank you. Thanks a lot.